let's say we go to UBI, right? It's not solving the problem, right? In other words, what's nefarious about the situation that we're in as a society is as people begin to fall below the waterline, right, and become financially desperate, they want stimulus, right? Hey, I got to put food on the table tonight, right? Like, please, government, give me something to make it through here, right? But that's just adding more of the problem, right? And it can't last forever, right? If the government could print an infinite amount of money forever and everybody would be prosperous, well, we've been doing that since Roman times, right? So let's say we switch to UBI here. What does that do to the story here? Does that just accelerate us to some point where the currency just gets inflated away to nothing? Or how long can we make it last on that?
I think it gets very nonlinear at that point, because now you're talking about UBI. I don't think the currency, I think the currency collapses. I think the currency is collapsing against energy, against food, against
real hard assets. Yeah.
Real hard assets. So I collapse is a strong word, but depreciating significantly. And the challenge there is this bond market, the size of the bond market, the size of the debt outstanding. And if we were in a system where it was basically purely equity-based rather than debt-based, it'd be a different story. But the debt makes it very nefarious in that you got to find someone to hold all that debt. Or if we were low debt, we could get away with it. And that's part of my point earlier with Volcker. 25% debt to GDP, you could take rates of 15, and it's going to hurt. A couple recessions, a lot of people going to lose their jobs, blah, 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 a lot of private bankruptcies. Who cares? The U.S. government is strong. They were never a threat. They can't raise rates to 5 before tax receipts are going to plummet. Countercyclical payments are going to skyrocket in the resulting recession. Your deficit to GDP is going to blow out. The U.S. government is not going to be able to cover their interest and interest-like expenses, which I call the true interest expense of entitlement pay-goes plus Treasury spending. They're not going to be able to cover it out of tax receipts, which means they either default or the Fed prints a difference. It's sort of the same. It's the governmental version of UBI. So you go to some sort of UBI system for political stability, you're speeding up inflation. You're going to make the inflation run hotter. You're going to put more pressure on the bond market because nobody wants to be the sucker holding a 3-4% coupon bond, a 6% coupon mortgage when inflation's running 8, and now going to run hotter with UBI. So now mortgages go to 8, 9, 10. Who number one, housing market goes down, so tax receipts go down further. You just can see very quickly it gets not, when I say nonlinear, you're basically going to put in a position where the Fed's balance sheet's got to go, 9 trillion, 10 trillion, 20 trillion, 40 trillion very fast. And inflation goes 8, 10, 20, 50, 80, very fast. Now, by the way, it's the way it has to go. We go 2 years at 80% inflation, debt to GDP is going to be at, 20, 30%. Fed can take rates to 15, 20, 30% for a year. They won't break the U.S. government. They'll break everything else, but they won't break that. I will happily buy Treasury bonds at 15, 20, 30%. And then they restart the whole cycle. And you know what? 40 years of a bond bull market, bond bulls, thank you for your donation and your service to the country. We appreciate it. You lost most of your purchasing power in a short period of time. On a real basis, you got paid every dime you were owed. And that's how this is going to go. The path is the interesting part, right? I mean, even in Weimar Germany, and I'm not saying we're going to hyperinflate, but in Weimar Germany, I don't think that's the base case. But in Weimar Germany, there were multiple times as the currency went from 0 to 1 trillion against gold, right, collapsed into nothingness. There were 4 or 5 different times in 4 or 5 years where the Reichsbank pivoted. It was the Havenstein pivot, and people were selling gold to buy Reichsmarks. It's the same thing we're watching now. Again, I don't think we're going to hyperinflate like that, but it's the same dynamic of, because the debt is so big, the deficits are so big, there's really only one way out of this, is you have to have significantly negative real interest rates for a sustained period of time, get that the GDP down, from which the central bank can raise rates without blowing up the system. Otherwise, you're going to get what we have here this year, which is, hey, the 60-40 portfolio of stocks bonds is down double digits on both legs. This has never happened before. It's like, well, of course it is. 120% debt to GDP, 7% deficits, and you're tightening. That's what's going to happen. You're going to collapse the system.
All right. And I think we can largely expect the status quo to do whatever it can to keep the system intact. So
I think that's inflating. That's why I say that latter. At the end of the day, when push comes to shove,
they're going to inflate.
Print the money.
Yeah. So following your logic here again, and I'm going to come back to my question just in a slightly different way here, and then I promise I'll leave it. But if we go the inflation route that you mapped out, presumably as the Fed is, pumping tons of liquidity in the system here, asset prices will go back up again. So it'll quote unquote kind of rescue the markets. Hopefully we'll get some additional economic growth out of that. But I mean, I think the past couple of years have shown us that we can shove a lot of stimulus into the system and not get a lot of GDP growth for it. So I'd say that's a little debatable. But, even if asset prices go up, they are hyper concentrated at this point in the hands of a minority of Americans. Right. So unless we have like a really substantial UBI, I just don't know how the average household keeps up with the increase in cost of living that goes along with all those asset prices here. And I mean, do you sort of see in that scenario that we have like half or more of the country that's literally just living off of checks from the government?
I think eventually, probably. I mean, I think there's things they can do. I think they're already teeing them up a bit, right? When you hear $10,000 in student loan forgiveness per person, that's, yeah, a lot of those student loan payments have been suspended, but suspended's different than forgiven. Forgiven means it's gone and you can now spend on something on the other side.
Right.
I think that's being teed up for a reason. I think, look, if I was in Joe Biden and the Democrats' position, which is terrible, well, first thing I would do would be resign. But if I couldn't resign, then what I would do if I was a career politician, I would, forgive student loans. Why not? It's stimulus. It's popular. It actually addresses.
It's popular with those with loans. I think that there's you open sort of a bit of a Pandora's box.
Yeah.
If you do it, because it's so preferential.
It's preferential, but it's preferential to a generation, by the way, that, to your point of, the boomers have 70 trillion in gross assets. Well, I guess it's 55 trillion now, but 55 trillion in gross assets, 25 trillion net worth. They've got all the money. And this younger generation is looking at it going, how am I ever going to get a house, a foothold in this ownership economy, the economy? This, I think, goes along. That a measure like that would go a long way in doing it. But there's ultimately, you get to this point, the bondholders win or the bondholders lose. And once and that's how it always is in any cycle. And if you expand the cycle time after time with bailouts, central bank stimulus, the things we've done, if you don't allow the defaults to happen, as we've repeatedly done, then the debt gets so big that it's no longer a choice, the bondholders win or the bondholders lose. Now it's the bondholders lose by inflation or the bondholders lose by default. That's
right.
it.
It's the classic von Mises quote, right?
It's exactly destruction of the currency or walking away from it. And we're there. And so there's no easy, and that's why I say the first thing I would do as I was a politician is I'd resign, because
it's a no-win situation.